Hey, welcome everyone. John Humphreys here, Executive Director of WAEF, Association for Equity and Funding, back with Matt Silkey for another market update and more tumultuous times in which we live. This will be an interesting one, Matt. We never get a huge crowd for this, but I will tell you that people ask me about it, and they do watch the video online because, especially if things are challenging. They're looking for some, I guess, reassurance, and it'll be interesting to see what you've got for us today. Thanks again for joining us, Matt Silkey from PMAT.
Close.
Sorry,
That's fine. It's new to us too.
for like two
Um,
years, right?
uh, things have been fairly gradual over that time, but yeah.
Well, we're
Can
glad
you
to
hear
have
me
you
okay?
join us. Yeah, it's great. Appreciate it.
All right, excellent. That's what the headset does for you. So yes, the spring edition of the AEF market update here, and you kind of took it away from me. I was going to make a joke about how the markets are just as volatile as the weather, but no, I don't really even need to do that. Let me get my screen sharing here. Oh, requesting.
Well, as volatile as the weather. That's that's probably good, and maybe even more so. I mean, we had this huge snow that was a month ago.
Yeah, it's been snow and then, 24 hours later, tornadoes with tennis ball size ice and 6 inches of rain in about a 36-hour span. So, yeah, quite a bit. Um, all right. So, let me get one thing here. So really, since the start of the Middle East conflict, we've been seeing a lot of dramatic swings in the markets, both in the rate markets and in the risk markets. But really just kind of want to start today with the Fed and the pause that they're on right now. We're still seeing persistent inflation. We're going to talk about that in some jobs. We'll hit on some investment yields. We'll hit on a referendum update. So everything that's pretty much the dust is pretty much settled now from April, but we'll touch on it a little bit. Kind of a muni debt forecast, and then just I think we'll settle in with some BPM basics or some bond proceeds management basics, just to kind of keep people in the loop about that. There's a lot of turnover on the K-12 side, so whether your district is already currently looking at something or you end up finding yourself in a position where your new district is. We'll just be taking a look at some good information there. Um, so again, just starting with um, the Fed held rates steady at the latest meeting. The overall outlook largely remained unchanged, but the mean or like the average of the dot plot that we're kind of looking at here moved up slightly, meaning that the expectations for a rate cut have been extended out. The median expectation following the meeting was around one cut for 2026, but internal views are still somewhat divided. Conditions for continued cuts were in place back in December, but um, following that, we saw a pause in January. Um, Following the last meeting, there were 7 votes for no cuts this year, and there were 7 votes for one cut this year. So really divided Fed, and you're kind of seeing some of that dispersion here in where these dots are and how far away that they really are. And again, these dots really just represent a vote of one member of the Federal Open Market Committee and where they see rates being, or overnight borrowing rates rather. Given a point in time. So, we're looking out here into 27, 28, and then what they call the longer run, or essentially 3 years down the road. Um, so on the market side, though, markets priced in a consistent path for the Fed following the meeting. They were still pricing in, 2 cuts, one around June, July, and then one in September, October. But more recently, they're showing only one cut in 20 September of 2027, which we kind of feel is a little bit of an overreaction to where the Fed's actually going to be heading out of 2026 and into early 2027. There feels to be a bit of a shift towards just a slower, more shallower rate cut path than previously expected. But, the Fed remains biased towards eventual rate cuts, not hikes. And their current stance of being on hold is just really just waiting on clarity for things like inflation trajectory and the impact of the Middle East conflict and where those energy prices are going to be going. So um, rate hikes, like I said, they're off the table. They would hurt the jobs outlook and they wouldn't fix any of the, near-term energy-driven inflation. But the volatility remains, and it's kind of seen as an opportunity for investors. On a personal side, obviously, people always say buy the dip. So in a volatile market, that provides that opportunity. But extending out the rate cuts is really, it's really driven up some of the short-term investment yields that are available to people. So if you're looking, to have cash, a lot of people are right around their high points following March aid. So if you're looking at investing, 3, 6, 9 months, there's certainly some short-term rates out there that were available, but more so now as a result of the extended forecasting for a future rate cut. So this is kind of where we were back in November of 2025. And if you recall, we kind of looked at sort of the 70% confidence interval. And I just kind of wanted to show that this has really come to fruition because we've really seen that divide at the Fed sort of grow, sort of as we saw here and as we had expected it might. We had the median projections here kind of heading through 2026, and we haven't really seen the rate cuts that were expected, but we definitely are seeing sort of um, the confidence level that they had really come to a head, and they're really not at a place where they're comfortable cutting rates. They're certainly, like I said, not going to hike rates, but so this is kind of where we sit right now in terms of Fed probabilities. Really early on in 2025, I think we expected to be right around 3% overnight borrowing rates, or what's going to amount to a money market rate by this time. And there's obviously been a long pause that's been put in place here, and now this is really the Fed probabilities that we're looking at here. So what's in blue is going to be the highest probability of where we're going to fall in their ranges of the federal effective rate. And so this is where we are today, 350 to 375. That's where a lot of people's money market rates are sitting. And you can see that right now, the markets are predicting that they're not going to cut rates again until, late 2027. And that's obviously withstanding some more clarity in the markets, some resolution in the Middle East. Stuff like that. So um, kind of moving on to inflation. So inflation remains just a little bit trickier. I'm gonna get that to move on. There we go. And stubbornly above the 2% target, which with limited recent progress, obviously this is going to affect districts' CPI projections and how they're going to be compensating their employees. The biggest issue here is core services and the inflation, which is not declining as expected. There's obviously rising oil and energy prices linked to the geopolitical conflicts. And that's increasing inflation concerns. It's driving market volatility. Essentially, the Islamic regime understands that they can't match the military powers of the West, and so they saw their best chance of either outlasting or surviving this conflict as long as they can, to inflict some economic hardship on the U.S. and the global economy, which is why they chose to shut down the Strait of Hormuz, which briefly opened and then now it's back closed again, and they're really is a lot of confusion about what's going on over there. So they don't know how that's going to end. Obviously, we'll all see. And the Fed is just a bit frustrated with the lack of disinflation progress. The key uncertainty is how inflation is going to behave with things like uh, um, market shocks. So like, or I'm sorry, supply shocks, market shocks. So things like tariffs, things like conflicts about oil and seeing oil prices jump well above $100 a barrel. Stuff like that. The markets, on the other hand, prolonged high energy prices are going to um, keep up this persistent inflation pressure. I'd say the best case inflation should eventually decline, but the timing is pretty uncertain and in all likelihood delayed beyond current projections. So the energy shocks are typically temporary, but the duration of the conflict right now is, like I'm saying, it's kind of the wild card. So we don't exactly know when this is going to end. So jobs flat. So moving on just a little bit towards jobs growth, the labor market has really stabilized, but weakened. So the job growth has slowed to essentially an average of around zero. And there's some government shutdown factors in there. There's weather-related factors, seasonal factors, some strike-related factors in there. Earlier strong hiring trends have really deteriorated, though, which initially allowed for 3 rate cuts in 2025. But unless we see job numbers, improve, it's really going to keep the Fed on the fence again. So with unemployment rising gradually, not sharply, the Fed, they previously cut rates due to the concerns about the labor market softening. But the current view is that the labor market is stable. It's not collapsing. It's fragile, and any shock could really kind of push it the wrong way here. Um, Companies right now, though, are in a very good place. They're less likely to lay people off, given the financial strength that we're seeing in some of the markets. The key risk with jobs is that if growth slows further or energy prices stay high, the job market could deteriorate even more quickly. Otherwise, the Fed appears, comfortable for the time being, waiting this out and continuing to hold. The big picture here is just the economy sits in somewhat of a delicate balance. There's stable but weak job growth, sticky inflation, and the Fed is waiting for a bit of clarity. So, um, moving on to the investment piece here. So, as we're looking at these investment yields, we talked a little bit about the shorter end of the curve and being driven upward. We're still given where liquid rates are at, unless you can really invest short term or go out somewhere near 2 years, you're likely not going to find anything that's going to be surpassing liquid expectations of what you should be earning anytime soon. Once the Fed does continue or get back to continuing dropping the overnight rates, that's when we're going to see really that more normalization of this yield curve here. And you can see that's kind of the dotted line here. So this is kind of where we are today. This is really where we want to end up, though. So. But in terms of where those actual investment yields are, so this is going to be kind of a snapshot of where, competitive bidding might be able to place some of your investments versus where we expect federal futures rates to be. And you can tell that kind of, coinciding with everything I've mentioned so far, everything is extremely flat. There are some higher yields on the shorter end, which, like I said, have been driven upward by the expectation that cuts are going to be kicked down the road a little bit. But you can tell that there's still certainly opportunity out there. So whether you're looking for, you got terms up here between 6, 12, 18, 24 months and so on. There's still certainly opportunity out there to be placing some fixed rates, provided you have the opportunity. Monitor your cash flow, understand when your liability dates are. But if you have the opportunity to, there's absolutely money to be made out there above where these liquid yields currently are. So jumping over to the muni and debt BPM basics, we just threw this in here. We did send this out earlier this month. This is just kind of a snapshot of where the spring referendums came in terms of results. I think one of the biggest shocks to me was what seemed to be the large amount of recurring operational referendums that passed versus how many were actually out there. It's obviously less common than a non-recurring. Communities are much less likely to pass an operational referendum when they know that it's going to be a forever thing. And then the other thing that kind of shocked me was that we only had, I believe it was 12 capital projects on the ballot. We only had, was it 230 million of the capital projects pass. Obviously, it was heavily swung by some of the larger ones out there. They were either very large or very small. But right around half of the dollars that were on the ballot passed. Heading into fall, I think what we're expecting is a much larger capital project layout. In my discussions with many districts, they were kind of pushing for April, but then realized that they either needed more time or had a better chance to um, get the public out to the polling stations um, uh, in November. Um, but in terms of looking forward, for anybody looking to kind of do any future planning, today's sort of non-market segment is going to be on, bond proceeds management basics. And so I kind of wanted to touch on a couple of these things. Uh, Oftentimes people that work in K-12s are exposed to one or maybe two capital projects throughout their career, sometimes none at all. And so we oftentimes begin working with people that have never gone through something like this. And so it's always worthwhile, in my opinion, to kind of just go through some of the top level content and just kind of make people aware of what they might be able to expect should they kind of go down this road. So this first slide is just a little bit about the roles and responsibilities of some of the people that you'd be working with. Obviously, there's the municipal advisor, GFOA, who I'm sure everybody's familiar with, puts out a list of best practices. And one of the best practices is that, you should always be working with a municipal advisor. They are a fiduciary to any public entity that goes to ballot, meaning that they have to have their best interests in mind. And so you'd be able to work with the municipal advisor to plan for your referendum. You'd be able to put together, those tax projections, mill rate projections, levy projections. And then, they would be there to kind of hold your hand through any community sessions and stuff like that. Some people do choose to work with just an underwriter, which many of those services are also available through as well. The one thing that needs to be known about working direct with an underwriter is that the underwriter is really there to purchase the district's debt and then basically resell it to the investors that they have relationships with. And so there's sort of this dual responsibility and they have a duty to essentially the investors who want higher interest rates, and they have a duty to the districts who want low interest rates. Um, and so obviously everybody's familiar with bond counsel. Disclosure counsel is separate because sometimes you can get that out of your municipal advisor. That's things like setting up your OS and communicating um, with ratings agencies on your behalf. The rating agency is obviously out here. One of the things to note is that we're going to take a look at some yields here. So a lot of people understand ratings, but they don't really understand the impact of what they bring to the table for potential bond issues. And so I think if you think about the different notches of a rating, you've got double A, triple A, and what we kind of like to see or feel is that it's about maybe 15 basis points kind of jumping from one notch to the other, and that's sort of how people can anticipate yields based on where their rating actually shows up. So on here is bond insurance. Obviously, if you are at a school district that doesn't have the best uh, bond rating, you can go out and purchase bond insurance, and then that will assist you guys in saving some money in the long term. Obviously, then once you issue the debt and you go through working with your bond counsel, MA, underwriter, all that. Then you will need to find somebody provided you want to. Some people with some smaller bond issues just choose to work local, and that's fantastic with local banks that have a strong support for the community. But in the instance that you have, a larger bond issue and maybe the local bank can't handle it, you want to set up with a bond proceeds manager who will go through some of what they'll do for you. But then you've got your construction team, an owner's rep, and a paying agent. The paying agent is essentially to organize your debt for you. A lot of people use, Associated or Zions in Wisconsin. Um, but one thing I'll note here is that while I love the idea of an owner's rep, I've noticed that districts that choose to work or bring on an owner's rep in addition to a construction team, oftentimes their spending targets can be a little bit disjointed. And so that's one thing I would caution people at. I think it's a great idea because owners reps are there on your behalf, and they're going to try and save you as much money as possible. But I would recommend, a level of communication up front saying, hey, we really want to zero in on our spending expectations for this project so that we can optimize how much we're going to earn throughout. And I think that's key. So that's just something I've noticed that I thought I'd mention. Um, Jumping over quick. So this is kind of a little bit about where, municipal market debt indices sit right now. So this is as of 420. So this is for a triple A GO bond debt issue. Most people that go to referendum are going to issue 20-year debt. I believe the last issue that we sold sat right around a 420, and that was a triple A issue. So if you're looking to go to market, just understanding a little bit about what you might be able to expect in terms of a yield, that bond yield is likely going to be higher than what you're going to be able to get on the investment side now. So over the last couple of years, we've had a lot of issues with arbitrage, and we'll talk a little bit about that. I don't foresee too many of those issues if you're extending out 20 years. If you're going to be limiting yourself and saving a little bit of money on the debt, if you have the ability to within your tax base, great. But just know that if you do that, then you will certainly need to be a little bit more aware about where your arbitrage figures sit. And we'll talk a little bit about how to track that and tell. But let's just say that you get to the point now where you've issued the debt, you've got a draw schedule. It's really important to understand your timelines. So you'll put together a financing plan. The financing plan is essentially going to draw out when you're going to pay the debt back, what the estimated rates are going to be at each tranche, and then when you're going to be issuing any subsequent bond issues. It's really just kind of a roadmap saying, hey, we have, call it $20 million. We're going to do 3 different issues at these times, and this is the anticipated payment plan for that debt. So what you have here is essentially the spending of that debt. So we're looking, at 3 different bond issues up here. And this is kind of how we like to draw this out, because depending on what your draw schedule looks like, so like this is like a monthly spend estimate here that we were provided by a sample district here. There are opportunities in the market. So with interest rates, pointed downward, really the idea here is that if you have a small issuer, which is an exception to rebate, meaning that you won't need to track your spending as much, um, you have an opportunity to kick some of that down the road and capitalize on the higher interest rates that we're seeing today, because maybe when the second and third bond issue arrive, investment rates are going to be where they're at. So if you're able to lock in these interest rates for a longer period of time, you're going to be better off in the long term. Not to mention that this period of time right here for this first bond issue, because it's under the $15 million cap for a small issuer, you're not going to be subject to the spending requirements. And so higher interest rates, no spending requirements means, yep, let's invest this one as far as we can. Each schedule is different. And so that's kind of what we did here with the second bond issue. And then this third one, making sure that you understand with large issues, you are going to be subject to those spending requirements. And so we really packed that in here where spending got a lot higher, making sure that they hit all their spend downs. Spend downs are relative to arbitrage rebate, and so there's 2 parts of arbitrage rebate, and that's I'm sorry, there's 2 parts of arbitrage, rebate and yield restriction. And then there's a few exceptions to those. So one exception is issuing $15 million or less per year, and the other exception is if you hit your spend downs. So so again, kind of taking from the financing plan, how many issues are you going to have? When are they arriving? What are the size of the issues? How can we coordinate this for people ahead of time so that we don't automatically put them, in harm's way? Making sure that you have an updated draw schedule. Does your draw schedule align with when you want to go to market for your next bond issue? Are you going to run out of money, or do you have too much money and you can kick that back a couple months and save some money? And then the IRS liabilities that I just mentioned, we'll talk a little bit more about those, but when to update your draw schedule, it's really important that when you work with your bond proceeds manager on the back end, that you keep this updated. On a minimum, I would probably recommend every 6 months, but certainly before each subsequent issue, because once that second issue arrives, you're going to want a clear picture of how you can invest those dollars. Otherwise, if you're working off of an old draw schedule, then you know, there's a higher likelihood that you're going to get hurt and not have enough money, or you're going to have too much and you're not going to be earning enough. And so just some things to think about as you sort of step into a potential capital project. Um, so prior to any of that actual investing, you're going to be required by bond counsel to complete your facts and estimates, which is going to say, hey, this is the source and use of the funds. This is how much we anticipate to earn both in the dollar amount and in the yield. And so we work with people to say, hey, with this bond issue, and then this is your draw schedule here. We will add in fixed rate earnings, liquid earnings. We'll look at asset allocation just to make sure that you're, excuse me, diversified enough to be able to sort of withstand some of the fluctuations, meaning, different securities are going to behave differently in the markets, and they're going to be a little bit more liquid than others. So if you have some of those more liquid options down the road, great, because, you can just sell it at the prevailing market value. And then we'll take a look at potential liabilities here and say, all right, well, it looks like you're going to hit your first three spend downs. Looks like you're not going to hit this one. So if you don't hit this spend down, this is what your anticipated liability may be. And so all of this is a part of the planning for the project, because the last thing you want to do is spend anything that could be considered liability, and then you have to take it out of operating. Multiple bond issues helps that, because it doesn't necessarily matter which bucket it comes out of, provided that you don't have to face any political issues of not having the money still in the right fund. And then when it comes to actually investing the dollars, this is a sample snapshot of how to competitively bid your portfolio. And this is something that we put together with all of our clients as well. And it's something that everybody should really, really be looking at, because what we have is a monthly draw schedule here for, a sample bond proceeds portfolio, liquid liquid balances at each month end, and then the federal effective rate range, which is also signified by the red lines going across. So saying this is where we expect liquid rates to be given a point in time. Where are those fixed rates comparatively to these what we'll be getting on the liquid side? And does it make sense to purchase all of these investments based on where we expect liquid yields to be? And it's not that we're trying to time the market. We're just trying to go into it with a really, really good plan. So having treasuries, FDIC banks that are bidding competitively through a network, and then local banks, provided they want to be a part of it, awesome. Let's get them a piece. And so we'll talk about which yields are higher, making sure that you have enough liquidity throughout the project, and then just moving forward with your best foot forward, I should say, as you begin to invest your bond proceeds. Imperative to many issues is tracking things. And so this is a sample report that we provide to people. So this report is going to provide estimated earnings based on the existing draw schedule, liquid yields and stuff like that. Where this is going to come from, we want to make sure that you're able to fund all of your liabilities. And so there's a cash flow piece to this saying, hey, these invoices are going to be funded by, these investments that are going to be maturing. It's going to show you exactly how much you have left to spend, principal and interest based on when the bond issue closed, how much you've spent, how much you project to earn. And so it's going to say, all right, well, you've got this much left to spend. And then arbitrage tracking. So this centerpiece here, which I'm going to kind of actually zero in on the next slide, is going to say, all right, well, this is what your potential liability is if you don't meet your spend downs. Additionally, what we're going to look at is, additional opportunities that you might see and how it works with subsequent issues. But this is kind of what I was just talking about. So people that are required to spend according to these spend downs here, it's going to, you should be aware of which spend downs you've met and how much you need to spend in order to maintain your tax exempt status. So saying, all right, well, we issued, $38 million. We met our 10% spend at 10%. We now 6 months from them have to spend 45. And that's what that dollar amount is, because it includes principal and interest and everything you're earning. So by that date, you need to spend exactly this amount. And being able to have that kind of foresight is really important in a high arbitrage environment, because this is the potential liability here for this portfolio was 500,000, which is a really big deal. That's a lot of money. Going to capital referendum is difficult and it costs money. And so you want to make sure that you're able to earn much or keep as much as possible throughout the process. But this is the file that we use to build out these. And so tracking every penny from the day the funds arrive, the day your investments go out. These are all of your spend down, I'm sorry, not spend downs, uh, expenses here kind of projected versus actual. And then here's your interest arriving and here's your liquid balance. So understanding uh, when you have extra money on hand. So if you get an updated draw schedule, you say, all right, well, we've got $7 million more than what was expected at this point in time. We just got an updated draw schedule and this isn't going to be spent for another 9 months. So we have an opportunity to get back into the markets and reinvest. That way you're consistently, optimizing how much you're going to be earning. Um, but at the same time, you're able to really forecast if you have any liquidity concerns, if things uh, get spent a little bit faster and you say, all right, well, 4 months from today, it looks like we're going to be in the red. So we need to figure out what we're going to do. Talk to our construction team. They said they're going to slow down. Okay, perfect. Otherwise, we can look at which securities or investments it makes most sense to liquidate so that you can fund your liabilities. And so that's just a little bit about sort of some best practices, maybe what to expect for bond proceeds management and stuff like that. Just kind of ahead of the November cycle, which, like I said, we're expecting to be a little bit more sizable for capital projects than we saw in April. Um, and that would be about all I have for today. So if there's any questions about that or anything I discussed, I'm happy to answer them.
Anybody feel free to unmute and ask Matt about these bond and other issues. Raise your hand. Uh, so Matt, I wanted to go back to something that you brought up earlier, the slide that talks about stubborn inflation, and you made the connection to CPI. Um, I'm wondering, it sounds like it, with inflation challenging, and then you talked about labor being sort of stabilized but fragile. Um, what's your thought on CPI? Is that likely to increase because of inflation?
Well,
Here.
I wouldn't say that it's likely to increase. I think that what we're seeing is that it's just stubbornly consistent and not dropping at the rate that we expected it to. So I
I
would
see.
I would feel as though it's going to be remaining consistent with what people have probably been seeing over the last um, 5 to 6 months. Hopefully, inflation does end up dropping to around that 2% target that we'd like to see it at. And at that point, then yes, I would consider CPI as something that's going to be dropping. But for now, I would just probably think of it as steady.
Kind of thought. Okay, great. And then, do you think, going back another couple slides, do you think what's the likelihood of another rate cut in 2026?
Um, the likelihood, let me see. I got one other piece I was going to take a look at. Let me see if I have it here. Nope, I don't have it up. Um, so in the interest of time, I would say that right now through 2026, the likelihood of a rate cut is going to be pretty low. If we do see a resolution in the Middle East sooner rather than later, it's possible, that Q4 of 2026 we do see a rate cut. There are still probabilities here showing, maybe a quarter chance of a cut. Um, but right now, just given the uncertainty of everything, I would say it's probably going to be pushed back to early 27, I would probably say. I still think the markets are overreacting a little bit. Um, but energy is what's really been keeping inflation a lot higher lately. So that is going to be driven in large part by what we've been mentioning. So
Always fascinating. Yeah, it's a complicated world in which you work, and you've got all that sort of market related stuff, and then all the investment side and the bond complications. And I had no idea all the stuff that went into the background when I was in the midst of doing a project, oh gosh, almost 10 years ago now. You're right. Most of us will only see this once or twice in our careers, maybe 3 or 4 times if you're a business manager who does this stuff regularly. But um, it's a complicated world. Really appreciate your insights. Thank you again for another really valuable market update, and we will see you again.
Yeah, as always, thanks. I appreciate your time. Hope it was a good one.
Yeah, and your contact information's on the slides and in the information there, Matt Silkey from PTMA.
Yeah, there you go. You got it.
Yeah, yeah. All right, very good. All right, thanks again, Matt. Take care.
All right, thanks. Take care.